Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from chartsandmarkets.com runs down the major markets. Toronto and New York took hard hits to just about every sector. Even so-called sure bets stutter-step their way down. Rick Ackerman, editor of Rick's Picks, concentrates on the U.S. dollar, peak oil, and whether the threat of inflation will soon peter out and be replaced by devastating deflation. Mark Leibovit, publisher of the Leibovit VR newsletters, is here to talk about how the Ukraine-Russian conflict is affecting the markets and what the long-term fallout from it could be. Plus, he has a special offer for our listeners. Plus, at the end of the show, we'll have a company showcase update from American Manganese CTO Zarko Meseldzija. We'll talk to Bob Hoye right after this.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.V, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to This Week in Money, Bob.
Yeah, Jim, thanks a lot. And This Week in Money was a whole lot of prices disappeared. It was quite impressive.
No fooling. I took a look at the Bloomberg market board. I think everything was dripping red by the end of the week.
Yeah, well, let's just take a look here. At Friday's close, S&P was down 3.6%, Dow down 2.8%, NASDAQ down 4.2%, crude oil down 0.75%, gold down, U.S. dollar was down, but it's been very strong. And then you look at some of the others here, scrolling down, nat gas down, wheat down, copper down, wheat 2.6%, copper 1.25%. Even your Treasury bonds, they're down 1.9%. Bitcoin down 2-point-something%. So it's been a very heavy day, but the previous, let's see, going back 2 weeks, and we did discuss it, was that there was a suddenly big outside reversal day. I can't remember which one it was, but by an outside reversal, you mean higher high than the week before. This is on a weekly basis. A lower low than the week before, and a lower close than the week before, and that's outside reversal to the downside. And it means that the market has suddenly gone unstable. And indeed, then this is followed through. So, as you know, we always follow the market breadth. It's another name for it. The health of the market is the advanced declines. And in a bull market, you have a lot of advances and very few declines, and everybody's happy. But then in a full bear market, the declines are overwhelm the advances, and everybody's unhappy. So, but the ADs reached their best in November, and early in the year were threatening to break down, and then they broke down. So we described that as the internals failed. And then you had the stock market set its high in early January, whether you use the Dow, the S&P, or the New York Stock Exchange Composite. And it has taken out key levels. Bank stocks, broker-dealer stocks. It's the erosion in the last 2 weeks has been widespread and taking out key support levels. So our piece yesterday and the week before said that it looks like a bear market. If it talks like a bear market, it is. And then yesterday's piece pointed out that, yeah, the bubble, actually it's the greatest financial bubble in history, is over. And every great financial bubble in history is followed by severe contraction. So all of the stories that have been very popular through this year about 1970s inflation coming back and prices are going to go to the moon, well, they've already been to the moon and are now vulnerable. But as I said, you've got key commodities down, wheat, copper, crude oil, that sort of thing. So, Jim, in my experience, this is that looks like the start of a bear market, and then in that it has been so highly speculative for such a long time, it's likely to be a serious bear market that'll prevail for some time. Now, if people want to get in touch with us, there are some places where one can find a safe place to hide that'll give somewhat of a return. If you go to cash or T-bills, you're going to go to 0% interest rates. Even going to gold shares may not be a safe haven for a while, but later on they will be. So, as I say, Jim, there are some things that individual investors can do to protect themselves and to get set up to make a reasonable return with a modest amount of risk.
Of course, with inflation in the picture, you say if I put it into a bank account or a GIC, I'm going to actually lose money. But is this a case of where do I lose the least?
Sorry to laugh on that one, Jim.
But
yeah,
true.
That's like the old saying, when a portfolio, an equity fund manager goes to defensive stocks, we always laugh and say, yeah, they're the ones that go down slower in a bear market. No, Jim, the inflation is over. The threat of inflation, it's been highly touted, and as I said, everything was going to go to the moon, and it's all in the market, and it's over. So the problem will be that in a post-bubble contraction, the interest rates, say for Treasury bills, go to zero. The Fed funds rate's going to go down, and unfortunately, yields for lower grade bonds and preferred shares, the prices are going to go down and the yields go up. So, as I say, we've got a few places where one can get some kind of a return with a reasonable amount of risk.
Mm-hmm. Yes, because everybody is different. It's hard to give general advice.
Yeah.
Bob, thank you so much for chatting with us.
It was a fascinating week, Jim, and I'm sorry that one is being so... it's actually a severe hit, and people should understand that and adjust for it.
My guest has been Bob Hoye, the Chief Investment Strategist for ChartsandMarkets.com. He was speaking to us from Vancouver. Up next, Rick Ackerman on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. He's speaking to us from southern Florida. Welcome back to the show, Rick.
Indeed, a pleasure, Jim. Thanks for inviting me on.
Rick, do the stock markets look like they're in a correction?
They're dead. Dead as Kelso's nuts, as the old saying goes, and I think we're very much in a bear market. Every rally is distributive. At times when the best short squeeze rally opportunities present themselves, even those rallies aren't going very far. So I think that the market is finally succumbing to reality.
Do you have a bullish and bearish case for 10-year rates?
Well, I've been focused on 3.24%, and it's an important number because we are, well, as we speak, the 10-year yield is at 2.9%, and it's been off a high of, let me get this here, a high of 2.95%. So we've got a little further to go, and there are a couple things you can infer from that. One is that even though everybody's talking about the Fed's going to raise rates forever, they're not. The market is going to raise the rates, and they're going to end raising them when it reach the point where it has so completely throttled global business of all kinds that rates won't need to go any higher to snuff inflation. It'll be, I guess you could say, self-snuffing. And it also has implications for a strategy that we've talked about before. I call it the barbell, named actually by a good friend of mine who is a wealth manager in Boulder. His name is Doug Mainfield. And the barbell hedge works essentially bullion against Treasury paper. And I felt the Treasury part of it was a little premature, and for the last, I don't know, maybe year or so, I've been suggesting to hold off on the barbell hedge, which is a hedge against the worst of times that seems so likely now to be imminent. But I think you'll be able to nail it when yields get up there in that 3.24% range. That will be when the hedge will be at its optimal value for purchase. I mean, yeah.
Is inflation likely to be the biggest concern moving forward?
No, it won't be. We'll be wishing for inflation when deflation gets done with us. And deflation is, I don't use the idiot measurement of deflation. It was popular for so long, namely, well, inflation is an increase in money supply and deflation is a decrease. Nobody even knows what the money supply is. When you count all fungible sources of money, it's really the number is, it's not possible to calculate even within 3 or 4 standard deviations, or 3 or 4, what would you call them? You can't get close to the actual money supply in this world, much less measure its growth. So I suggest to understand deflation, just think of it as an increase in the real burden of debt.
Could oil have topped?
Well, that was the headline on my commentary, my latest commentary, What If Oil Has Topped? And that would in itself signal that this inflationary binge, consumer inflation binge that we've been on is at an end. Crude is an interesting case because Americans have been somewhat defrauded by these hugely higher gas prices because to the extent we import energy, it should have gotten cheaper because the dollar has strengthened. But for all other purchasers in the world who have to trade usually their currencies to buy oil, have to convert into dollars. Oil has become even more expensive for them.
Now, I'm hearing from people in the oil business. We have President Biden. On one hand, first thing he did on the first day of office was cancel the XL pipeline, which would have brought nice Canadian secure crude from Alberta down to Louisiana to be processed. And then all of a sudden we have a war between Russia and Ukraine. Global oil supplies are concerned. Apparently he asked China to pump more oil, and China does pump a lot of oil, but they use it all themselves, mostly for their military. Canada would love to supply more oil, but we don't have the pipelines to get it out to market. What do you do when you have this kind of two-faced government in charge where on one hand oil is evil, and then they're urging everybody to produce oil in places like Iran and Venezuela, who are considered to be enemies of the U.S.?
Well, we've got, as far as the politics of it, Biden is just being Biden. And he's known for having absolutely perfect pitch for doing the wrong thing. He's never done the right thing ever. And of course, the decisions as regards oil supplies have all been pure Biden. But concerning the global supply and demand picture, and actually to sort of finish with your previous question, it's very hard for me to see oil go much higher here because the the pricing at the margin really occurs because of buying by China. China at the margin is really what accounts for the demand for oil that pushes the price up or down. So China is in quite a wallow right now, especially its manufacturing economy, and of course the financial bubble side of it is starting to weaken as well, or I don't know what would a bubble do. It's near the point of inflection as is our bubble. So I can't, for reasons of supply and demand, I can't see a further squeeze on supplies quite keeping up with the decrease in demand that we're going to see with the global slowdown.
Mm-hmm. And with China still locking down cities of 25 million like Beijing and Shanghai, every time a case of COVID shows up somewhere, that doesn't really mean that they're going to be able to meet their financial targets. And this will be the first time, because for the last 12, 15 years, China has always said, we predict 6.7% growth this year, and a year later, they hit precisely 6.7, not 6.69%, but always 6.7, or whatever the number is. Can you ever trust the statistics or numbers that come out of China?
Well, I think China, they used to be smart about everything, but it almost feels like they're taking their advice from Joe Biden. But as far as the Chinese figures on output, they're probably as reliable as the one Stalin used to put out on the 5-year plans. You know, every goal was met and then some, but of course we know that at the same time there were tens of millions of Russians starving to death. So, yeah, I don't think you can trust those numbers.
What can we learn from Putin pegging the ruble to gold?
An act of genius, really. I mean, I talk regularly to a fellow named Sean Brown from the hedge fund world, and he's had some remarkable success playing a hedge, rubles versus gold versus dollar. And since ordinarily you'd think, well, the ruble would be sinking because the only thing Russia's got to sell is energy, and a lot of their buyers have embargoed Russian natural gas and other fuels. So you'd think the ruble would be sinking, but it's actually appreciated even more than the dollar relative to gold since Putin announced the peg. And certainly there's a lesson there for all the countries that ganged up on Russia and said, well, you know, we're going to bring you to your knees and get you to leave Ukraine. But not only has he not left Ukraine, but he's made a success story out of the ruble. I don't think it can last. The gamble on his side is that at some point everybody's going to say, well, the emperor's wearing no clothes. Russia produces very little of value other than fuel. So why should the ruble be strong? So there is that risk there, and the risk is there even in a dollar gold ruble hedge, which is constructed for those of you who are sort of trade savvy. It's essentially a box, a four-sided relationship that doesn't change, but which can get bent out of shape. So anyway, when you see, it's obvious that China's going to fall in with that, and a couple other countries are going to say, we really can beat the dollar. But as I've been saying for all the years we've talked, certainly nobody's going to push the dollar from reserve currency status, simply because no currency can handle the action in what amounts to the business of planet Earth, which is shuffling paper. You know, it's all about leveraging financial instruments, many of them too esoteric even for financiers to understand. So as long as the dollar is the only currency that in which that game can happen, it's going to continue, in, at least de facto, to be the reserve currency. That's not to say that at some point the dollar and all the depredations of the US of A don't come home to roost and kill the dollar. But for the time being, the strength in the dollar is the theme, And the last few times we've talked, I've challenged all the people who are screaming inflation, inflation, inflation to explain the strong dollar. And they can't. The simplest explanation is that the dollar's crap, but relative to all the other crap in the world, it's less crappy. So the problem for the Fed is that the dollar has really gone out of control. And this is something I've been writing about for not just years, but for decades. The idea that for all of the shenanigans, all the success the Fed has had inflating real estate and financial assets, the big enchilada has always been the dollar, and it's a much bigger game than anything the Fed has played with ever. And all the central banks in concert they're just spit in the ocean, really, relative to the size of the dollar monster they've created. So here, with this shrill backdrop of inflation, 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 we've got the dollar going higher in a way that will be devastatingly deflationary. And that's simply because every single dollar that's owed on this planet is getting more expensive to repay as the dollar moves higher. So the dollar's at the threshold right now of a breakout, and the dollar index above 103, a level that's been hit or close to hit over the last 10 or so years, a couple of times. So it's really at a crucial threshold, and I don't think it's going to turn tail and sink, and that's regardless of what the Fed wants. The last thing the Fed wants is a strong dollar. The last thing anybody wants is a strong dollar. And that's what's happening. And it's way beyond the control of the Federal Reserve. And it's going to be the big theme, over the next, not just year or two, but probably the next 5 or 10 years. So it's happening now. And, one thing that I've written about, I think I was the only guy writing about this back in the 1990s, was the prospect of a short squeeze on the dollar. And that's where I think we are right now. We're just entering a short squeeze, and it is so powerfully deflationary that you're going to see how ineffectual the Fed is in dealing with it.
Yes, and countries around the world owe most of their debt in U.S. dollars. Places like Turkey and Argentina seem to be in permanent financial crises, and their money worth almost nothing. But what happens when major players around the world start to see that happen, when their U.S. debt is unserviceable?
Well, what happens is what's happening. There's enormous pressure on all these countries that live by exports. Japan, all the other countries, even smaller, even third world countries, they are having to keep their currencies from appreciating against the dollar. Otherwise, they won't be able to sell anything. So all the countries now are being forced. The U.S. is exporting inflation, and at the level of what are the countries that are being exported to? What do? They really can't let their currencies continue to appreciate against the dollar. So they're either, in the case of Russia, pegging to gold, but in all other cases, if they don't have any gold, they have to do currency. They have to go into the markets and buy dollars. Sell dollars. And obviously that's a strain on countries that are not really doing so well to begin with. So this again is the process is feeding on itself. That's why the Fed won't be able to put the brakes on the dollar. It's just going to keep going up until we have a deflationary crash. But there's nothing they can do about it. So we are exporting inflation, and it's a monster.
Now, the UK and Canada years ago sold off all of their gold. We don't know if the U.S. has any gold in Fort Knox at all. The last audit was done back in the early 50s. So was it a big mistake for Western countries to sell off their gold at bargain prices years ago and not stock up again?
I think you've answered that question. All I'd say was, what smart guys? I think Britain almost seemed to, the sale price relative to what gold was doing at that time, they looked almost to have They might have hired a technician and said, look, we want to sell gold at the absolute low here before it takes off. So that's what happened there. And you can see that the countries that have held on to gold, that have valued it, that have allowed their citizens to accumulate it, that have encouraged that, China and Russia to name two, they're doing just fine. And although ultimately no country can hope to sell anything if they're selling it in gold, and that includes energy, you know, how much natural gas are you going to sell if you make your customers pay for it with gold? So Putin's the tactic is somewhat limited, but it's working for now. But to gold, as China seems to recognize, will be a very useful asset to hold when the time comes to assert themselves monetarily, economically, in the throes of the economic collapse that's coming for, well, not just the West, but for China as well.
We talked about the Barbell Hedge before. What exactly is it, and how does it work?
Well, it's a portfolio of Treasury paper, longer term, 10 to 30 year, against whatever gold hedge you want to hold. It could be GLD, the ETF for gold. It could be physical gold. It could be even gold futures. The more esoterically, you could short puts on gold or something like that. But when we've talked about it in the past, I've sort of put out the different scenarios. Like if the U.S. economy is about to go to hell in a handbasket and we're going to have a bear market, which is something that has never not happened, then what scenarios might eventuate? And if you try to figure out, if we're on a barter economy, let's say, and people are trading gold coins for loaves of bread, or maybe things aren't that bad. Maybe we're just sort of muddling by, and the cul-de-sacs in the various neighborhoods are all helping each other through, helping their neighbors through hard times. But whatever you can imagine of what's coming when this bubble pops, and again, I'm saying we're seeing it pop right now. You can't imagine any scenario in which gold and treasuries would be falling at the same time. It's really hard to figure out a scenario in which that happens. But there are many, many scenarios where gold could fall and treasury paper could rise, or the opposite, but usually there's an offset where the rising side of the hedge is more robust than the decline. And there are some scenarios where both do relatively well. But anyway, it's if you sort of set your imagination to the task of wondering how can this hedge go wrong, it's hard. It's hard to come up with a scenario. And of course, to begin with, you're buying stuff that everybody hates. And of course, it's an axiom of investing that if you buy stuff that no one else wants, eventually you're going to do just fine. So nobody wants treasuries right now, and I mean nobody, except the few people I talk to who have their clients pretty well exposed to treasury debt. But and of course, gold has been somewhat shunned. It's been in kind of an arrested bull market, a bull market that keeps refusing to happen. But you could also say that the bears haven't had much success in killing gold either, as much as they would like to sell it, as much as the scumballs who dominate the gold market, the bullion bankers, would like to bang it down so they can simply cover what they've shorted at zero cost. Gold has certainly held its own. You know, it's trading up closer to 2,000 than to 1,200. So it's just in a bull market waiting to happen. I'm not a gold at $5,000 an ounce kind of guy, because I think that even at $2,000 an ounce, with the collapse of all other investable assets, you'll be doing just fine to hold on to your doubloons.
Is treasury paper a safe place to be?
Well, it's been a horrific place to be over the last, I mean, the bondholders have gotten schmeiced, really. But even there's a limit. Even with the Fed doing everything it can to blow out treasuries, to raise rates, and to supposedly to clean up its balance sheet, but and the prospect of like who's going to be the buyer of all those bonds when the Federal Reserve stops buying. But so that's what spooked bonds down. But I'm suggesting that just for purely technical reasons, I think the upper threshold is 3.24% on a 10-year. And I can't tell you exactly why, but I do know that things that are kind of spelled out on the charts have a way of coming true, and then you figure out why thereafter. So I think we'll be at a peak, really, maybe a very important peak when the 10-year gets to 3.24. With 30-year, the spread is minuscule right now between the 30-year and the 10-year, so I treat them effectively as the same. But the 10-year has such a clear and compelling target at 3.24%. I think it'll correspond with the 116 target that I've been using for TLT, which is an ETF vehicle you use to play the long bond. So anyway, we're getting to the point where I think treasuries will be a pretty good buy.
Does it look like a recession could be around the corner?
That's a funny thing. You know, in my current commentary, I mentioned that the geniuses at Goldman Sachs put out in a headline, if you can believe this, they think there was a 15% chance of recession within the next 12 months and a 35% chance in 24 months. So now this was a week ago, and I put out a thing. I have a subscriber, Matt Barnes, who says he's in the shipping pallet business, and of course that's very, very close to the economy. And so Matt said, well, if shipping pallets are your indicator, we're already in recession. So not ironically, really, but just as you might have expected, we've had this announcement yesterday that GDP came in negative when it had been estimated at 1.1%, I think it was. So I don't think there's ever been an instance in history where the estimates missed by so much. You know, they're talking about a positive number and we're actually negative. And all the usual blithering idiots were talking about, well, it has to do with inventory and oil prices and this and that. But that's a lot of crap. I mean, we're in recession right now. And, you know, the whole Goldman thing about, well, 35% chance of recession in 2 years, I think we could look like 1930 in another 2 years. So yeah, we're in recession now.
Well, the U.S. saw GDP drop 1.4% in the last quarter. Canada, in the last month, saw its GDP go up 1%. Why is there a difference between the U.S. and Canadian economies at this moment?
Well, they use Stalin's formula, I guess, for calculating GDP. You know, we all do. Who the heck knows what GDP is or what the actual rate of inflation is? It's all a bunch of hokum anyway, and it remains hokum until you reach the point where nobody believes it. You know, we could be wallowing in depression, and of course, statistically, we would only be having this mild recession. So Canada's figures are just nutty, like fixed, cooked like everybody else's.
Now, when we talked about recession, usually the first sign of that is layoffs happening with companies trying to maintain whatever cash or profit they had. Robinhood, who was making headlines 2 years ago by putting all these short squeezes out on things like AMC, they've laid off 9% of their workers. Or other high-tech companies or financial companies like that going to start letting people go?
Well, that trend might almost be indistinguishable from one that's been going on all along. You know, if I go to the bank and I look, and it's very ironic because all the banks, Wells Fargo, Chase, Citi, they've made sort of showcase. They've showcased their minority hiring, and so they've got a lot of minority staff in these little sort of assistant manager cubicles. But we all know that there's not going to be any branch banks in another 5 years. The banks have all lowered the boom, and at the same time they're sort of boasting of their of success with affirmative action. But the jobs won't be there. None of the banks really want to do business other than through automated tellers or whatever. And the only reason you see the branches out there is the same reason you see movie theaters. It's like, what else are you going to do with all that commercial space when there's a vast glut of commercial space to begin with? So that's the reason for the survival of the theater chains. The landlords are thinking, well, I'd rather have them in there failing as a business but paying me $3.95 a month rent than to have to shut the place down and keep paying taxes on it and wonder how to demolish or refurbish it. So all right. So I digress. Coming back to your original question, the whole thing about the first sign of recession is layoffs. There'll be some of that, but I think that the macro, the secular trend of replacing every human being with some sort of stupid algorithm, that will mask the effect of recession layoffs to some extent.
Of course, with this huge push to AI, robots doing everything, those robots will be replacing humans. What will the humans do, and will there be any humans around to buy those products that the robots are making? Yeah,
there was a Twilight Zone episode about that. They were automating everything, and finally the guy was putting everyone out of work, and the genius of all the automations, he was eventually out of a job himself. But I think as bad as the layoffs is the stupidity that's going to rule our lives, because I haven't seen anything that remotely impressed me with AI, with the exception of, well, I don't even know what the exceptions would be, but I certainly, when I look at how it does with autocorrect when I type, I'm thinking, do I really want this same idiot algorithm to be driving me around town? So, and you think with the billions of dollars that get shot into driverless cars by big companies like GM, they've all backed away from it because it was just an idiot story. You can see for yourself, we're not going to have driverless cars like in our lifetime. Not to any significant extent. They work just fine if all the roads are filled with driverless cars, but getting from here to there is very difficult. And so everywhere I see artificial intelligence working, whether it's at a Costco checkout, the self-checkout counter, or in the phone menus, or in companies that I call that they don't even know who I am when they've transferred my call 3 times. It's garbage in, garbage out. So we've got millennials who never got past the 6th grade doing all the coding, and AI, as far as I can tell, is pretty stupid, and it's very overrated. So I'm not looking forward. Well, I won't be around really for the worst of AI, but I think we have to go through a very deep valley before we get to some AI that's somehow working for us.
Yes, that just reminds me of the joke, welcome aboard the world's first fully automated flight. There are no humans on board. Nothing can go wrong. Go wrong. Go wrong.
Right. That's it. And you don't want to get on that plane when you find out, hey, where's the pilot? It's just, I don't know, it's stupid. It's a lot of hubris. And when you see an AR car occasionally smack into the side of a truck that it mistook for sunshine, we're just not making much progress there.
Yeah,
and the one encroachment we really have to fear is AI in medicine. This idea that teledoctoring or even telesurgery is going to work. I'm not quite there yet with that. When someone cuts out one of my lungs or something, I don't want that the robotic hand to be guided by the one surgeon within a 1,000-mile radius who's actually done that job.
Rick, before we go, can you maybe just tell us a little bit about your newsletter, Rick's Picks?
Well, it's a lot of fun. We really talk, I guess, in an editorial way, and I do put out a commentary on weekends. But the heart of it really is the chat room. We've got some of the best traders in the world in the trading room, and the nice thing is it's not a Tower of Babel where everybody's talking about something different. Most of the guys in my trading room have taken one or more of the courses that I offer in ways to get into a trade. So Rick's Picks, you can get a free trial subscription at rickackerman.com. Just click on free trial, and be sure to say hello if you come in the trading room. Or the other room is called the Coffee House, and there the discussion can kind of go in any direction.
Rick, thank you so much for being on This Week in Money.
Well, I really appreciate your inviting me on, Jim, and I look forward to our next talk.
My guest has been Rick Ackerman, editor of the newsletter Rick's Picks, his website, rickackerman.com. Coming up, Mark Leibovit, next on This Week in Money.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMY.ZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. He's speaking to us from Arizona. Welcome back to This Week in Money, Mark.
Thanks for having me back, Jim. And as you know, we publish vrtrader.com, but we are not financial advisors, nor do we give financial advice. It's an educational service, so many people do look at the ideas and decide how they want to implement them.
Mark, do you have a special offer for our listeners?
We do. If you wish to subscribe to any of our newsletters, you go to VR, that's Victor Robert, vrtrader.com. VR stands for Volume Reversal, which is my technical tool, which has been registered for many years and is available on Metastock and TradeStation if you're technically oriented as an add-on indicator. Meanwhile, if you want to sign up for any of the newsletters, you go to vrtrader.com, and any of the order forms that pop up depending on which newsletter you pick. And then we have all different newsletters, as you know, from metals resource to cannabis to the regular market, and our forecaster, our annual forecast report, which has been working out very nicely. You enter the promo code 2022 half off, 2022 HALFOFF, and you get 50% off of any subscription for any time frame you specify. And it's, again, 2022 half off at vrtrader.com.
Mark, it was a tough week on the stock markets. What do you see ahead for them?
Well, you may recall that I've been a bit bearish, and I think we're going lower. For those who are familiar with the expression "sell May and go away," and, it started a little early this year. We had a series of tops. It wasn't just, a top a couple days ago. We started out, actually many of the big name high-tech names, they call them the generals, the big NASDAQ names, but for the S&P and for the Dow Industrials and for the big stocks, the top occurred on January 3rd, right at the beginning of the year. And, for the generals, these are names like Netflix, Google, and Amazon, and Facebook. You can run down the whole list of the big NASDAQ names. They actually peaked out back in November 22nd before the U.S. Thanksgiving. So they were sort of, and that's not unusual, by the way. This has happened in previous market cycles where you'll see the NASDAQ stocks top out ahead of the other blue chips or other market names. And even the small stocks like the Russell 2000 gave early warnings as well, and then they actually sort of been leading the market down. So anyway, the point is there's an expression "sell May go away," but it actually started before that. But we did have a little trading peak here, in the last few days, and so unless May inverts or suddenly there's some other major news that could turn the market, you would expect general weakness through May, and some would even suggest all the way until the fall, where you get your traditional, big sell-offs, or if you're well, in many cases, market crashes as well. Seems like we're crashing now, but it could last a good part of the year. So we're technically oriented as well as trying to use a little contrary opinion and a little common sense. So long-winded response. I would remain cautious. We can go into more details as we proceed here.
Are there sectors of the stock market you're bullish on and sectors you're bearish on?
Well, I'm definitely bullish on Twitter, which is the Elon Musk takeover. The stock's holding up pretty well. I'm sure there are forces out there that are trying to break the deal up, but I think he's pretty tenacious. So, the stock's in the high 40s, and I suppose it could drop to the low 40s and some type of market shakeout. But he's bidding $54 a share, so that would make sense. Also, with all the turmoil with Russia and so forth, and the flight into alternate energy, uranium is still high on my list. We had a little pullback here the last few days in the market. The talk of nuclear and all this kind of stuff has become to the forefront. So I take a look at the nuclear stocks, many of which have pulled back here, 10 or 20% recently, and I'm still eyeing the gold and silver market. But unfortunately, we get into this more, but the U.S. dollar has been strong, and though these markets can diverge, they can go in the same direction. They don't always have to be inverse. Just in recent sessions, the strong dollar has sort of put a lid on gold and to a greater degree silver. But at some point, I think they're going to take off again here, and whether it's an ongoing move to the rest of the year or just a trade, we'll see. But I think you got to be ready to put the buy signal back on that sector, since they've already pulled back here a little bit. And if the dollar decides to correct its recent run up, and it's way extended, by the way, if you look at the charts, the dollar has run up quite a bit. If it does go through a little bit of a correction, that would help obviously gold and silver. So that would be another choice. There's always individual names like the Twitter that I mentioned. Some of the defense stocks, for example, are probably still have a lot of life left into them, like Lockheed Martin and so forth. There's still a war going on, and it could get worse. So, I would, definitely take a look at that. And also agriculture, still strong. Many of the agricultural ETFs, whether it's corn or wheat or soybeans, or even the ETFs that represent the agricultural sector, there's still food shortages. There's going to be more of what the charts are telling us, and you should take, you're buying them high here. I mean, it's not like we're catching bottoms in these things, but there's still, buying interest in those. So, just off the top of my head, those are just a couple, areas to look at.
What do you see ahead for gold?
Well, a lot has to be proven on the gold bulls part. I mean, we had a big top 2 years ago, and then we came back in that 2050 to 2070 range, and we created what is known in technical jargon as a double top. And there's an expression, when you see a double top, you sell a double top. And sure enough, after gold ran up here, a couple months ago, late last year, it's been pulling back and running through all kinds of indigestion here. So cycles and, the strength of the dollar or weakness of the dollar have a lot to play with the next phase here in the gold market. But if we get a pullback, as I mentioned a moment ago, in the dollar, or there's something that really triggers the gold movement, some other factor that is unknown to me at the moment, but something that triggers, buying, some shortages or something else comes up. We know that Mr. Putin is backing the ruble with gold, and China loves gold and is backing to their currency. So, some news could constantly come out that could strengthen the gold market, but we're going to have to clear that double top formation, which is in that 2050, 2070 area, which is still quite a distance from where we're at right now. You're talking $150 or more higher. If that happens, and it could happen, then I think you get a nice run, a couple 300 points above that, and that would be a nice trade. So I'm giving you more of a trading comment for the tenacious bulls out there who hold forever. I guess my comment is irrelevant, because at some point it will be substantially higher, but at some point it could also be substantially lower. It's been very volatile these last few years, but net here, I'm waiting for a breakout above that double top and or some weakness in the U.S. dollar.
The U.S. dollar is continuing to climb higher right now, but what do you see ahead for the greenback?
Well, right here it looks a little trady toppy to me, and that's encouraging me that maybe gold could have a little uptick here. It was up a little bit today. It was up earlier today, being Friday. It was up more earlier in the session, and then it gave back some of its gains. But I'm looking at the chart of the dollar. It's definitely in a big uptrend with uncertainties in Europe and Ukraine, and risk of a greater expansion of the war. Dollar could be, again, flight to safety, and it could stay up and fool me and not have a technical pullback here, which what the charts are saying should happen. It's real extended. It's got some technical gaps to the upside that theoretically should be filled, but, it could be at a later time as well. So, as a trader, it looks a little toppy to me here, and that would suggest that, you would be short the U.S. dollar and long gold here for a short-term trade, but if the dollar breaks out above the highs it made a couple of days ago, I'm wrong, and you have to respect the strength in the U.S. dollar, which unfortunately would mean potentially further weakness in the gold market.
Mm-hmm. I was just going to ask, what is the current relationship between the U.S. dollar and gold?
Well, they, all the pundits who study this market just say there's an inverse relationship. In fact, all commodities, since they're priced in dollars, including gold, tend to move inversely with the gold market. So there's exceptions. We've seen periods where gold runs. You see commodities running up, like the agricultural, even though gold, the dollar has been strong. So I'm just saying, you can't. It's not carved in stone. But as a general rule, strength in the dollar is bad for commodities, including gold. It's a very general statement, but I tend not to follow that religiously. I like to look at each chart and see if it is breaking that pattern, because again, there are times where they diverge and you get caught thinking it's always inverse.
What will the Federal Reserve do?
Well, my personal hope is that somebody decides at a high level to abolish the Federal Reserve, and that nobody on any of the financial stations that talk about the Fed or Powell's decision about rates even raises the subject. They just think that this is it's an institution that's carved in cement. It's like looking at the Bible. You don't want to change the Old or New Testament. It's something that's always existed. Therefore, we should treat the Federal Reserve that way. And I argue that it's about time someone starts talking about getting rid of it. We've had some congressmen in the past talk about it down here. It was created back in 1913. I know I'm talking on deaf ears here, and people are probably hanging up right now saying, who the hell is this guy? He's talking about abolishing it. Well, it could be abolished as easily as it was created, and it's caused nothing but damage to the U.S. dollar, and I think to the world since it's been created. And I mentioned this before. I know Andrew Jackson in the 1840s abolished the national bank, and I think we need to do the same thing for the Federal Reserve, because it just, look what it's doing now. It's never right. It's always behind the curve. It causes damage. What's his name? Alan Greenspan got tongue twisted there. He slamming on the brakes, slamming on the accelerator, didn't know which way to go. The Fed's starting to do that now. And there's some idiots out there on the Fed or former members are saying, gee, let's just raise rates so high that we crash the stock market. That's what we need to do. I mean, we just need to crash that stock market, because that'll really help inflation. People will feel poor and they won't buy anything, but who cares who suffers, and who cares if we ruin businesses, and who cares if we go into a recession or a depression? We're just going to raise rates up and just torment everybody. I mean, these are idiots, because the inflation was not caused solely by actions of the Federal Reserve. It was caused due to COVID, this world conspiracy regarding COVID and closing the businesses down, and the resulting supply chain issues, many of which may have been artificially created, growing demand for certain products. A lot of things caused inflation. There's not some easy money on the part of the Fed. I mean, think about it. I mean, there's been easy money on the part of the Fed since the financial crisis in 2008 and 9. So you're talking all these years, suddenly at this moment, now we have to pay the piper and undo all the supposed damage that has occurred? No, there were other factors that were involved, politics and all kinds of things, a lot of spending of money on a fiscal basis by the U.S. government, which had nothing to do with interest rates or the Federal Reserve at all. So, they're just crazy. And, we're just going to have to deal with it until someone's got the nerve to say, we got to get rid of this institution, which is not even part of the federal government. It's a private, federally chartered corporation. And the salaried employees there are not even paid by the U.S. government, which very few people even know. So it's something, it may not happen in my lifetime, but it's way overdue. And meanwhile, what's happening with the Fed? They're playing games, and they're going to cause damages. And at some point, someone's going to say enough is enough.
Could the ongoing depopulation agenda be considered World War III?
There's a whole theory out there that everything from COVID to the Ukraine situation and so forth are just part of, a quote-unquote worldwide conspiracy to depopulate the planet. And there's been a lot of papers that have been authored that have been out there, that have been authored by some very famous people. I don't want to mention names, but top names of U.S. Major corporations, talking about how there's too many people in the world, and how maybe we need to spread some type of virus out there. And there's been a lot of literature for over 10 years about this. You can argue, well, COVID didn't work. Now we got to start a war. I think, honestly, World War III has probably already started. And to be honest with you, I just think that this reminds me of Pearl Harbor, where we created Pearl Harbor by withholding crude oil to the Japanese. There were embargoes, everything at the time. There was no surprise that they were pissed off and they would do something. The various embargoes, banking regulations, the SWIFT sanctions, all these other things do nothing but create problems, and all wars are generally economic related. So, bottom line is we have the neocons, we've got the military, industrial military complex that Eisenhower has talked about. We have, we have serious debt problems. We have Europe in negative interest rates who have not been able to turn the European economy around. So somebody out there is saying to you, we need a war. This will help clear things up. We'll probably get rid of some of this, debt. We'll be able to clean the system, start afresh. There's all this talk about the reset and starting over again. And I don't have all the details for you, but we can talk about that in a moment. But the bottom line is, war would definitely help depopulate the planet, which is the goal, unfortunately, of some people. But unfortunately, I think the actions on the part of the U.S. government right now and other governments by supplying munitions and military aid to Ukraine and everyone else is going to do nothing but aggravate Russia even more. And someone's going to accidentally push the wrong button at the wrong moment. And I sort of see a dire future here unless we get our act together. And it could all been avoided to begin with. And I don't want to make this a political dissertation, but I know Putin would have been happy if Ukraine was neutral and there were no atomic weapons near his border, and he had discussed this for many years, and if the people had sat down and talked intelligently with him about what really needed to avoid any conflict, none of this would have really happened. And I think it's been instigated, unfortunately, by forces that be both here and in Ukraine who are looking for a conflict, and it seems to be expanding the way I'm seeing the news. So hope I'm wrong, but I think this is going to hurt everyone, and it's going to hurt the world financial system even more, and shortages are going to become even greater, and the Federal Reserve could sit all day raising interest rates, but if something like this explodes, the shortages and inflation will be so great there's nothing they could possibly do on interest rates to change it, and there's going to be, in my opinion, a huge embarrassment on their part if and when this unfolds as I currently foresee.
We're hearing Putin's the good guy. We're hearing he's the bad guy. Could Russia be the theater for military World War III?
Yeah, I think I pretty much just answered that one. I believe so. I think it may expand now into Europe, and it's something that's being desired. I know it sounds cockeyed. Why would anybody want war? Well, people make money on war. They sell a lot of munitions and military equipment, and it helps move things along a little bit, clean up some problems. And, it's not, it's unfortunately the markets tend to like war more than they dislike war, unfortunately. And so much of businesses are dependent on the military and on the Pentagon and on others, other areas related to the war machine. So, I'm not saying Putin is a good guy. I mean, obviously he killed a lot of people here. It could have all been avoided, in my opinion, with intelligent negotiation. But you see, we have this one world government viewpoint, and we can talk about that, about the Klaus Schwabs of the world and the George Soros of the world, because Klaus Schwab is this nothing less than a Nazi who's in Germany, who's been talking, and even apparently Trudeau in Canada spent some time with him years ago training or studying under him. Basically, he just says, you'll own nothing and you'll be happy is basically his premise. And he's looking to create disruption in the world, and this is one of the things that Putin was fighting against. And the Chinese certainly don't want to be part of any one world government. They want to control the world, and they want to be in charge. And Putin wants to keep his Russia independent with his beliefs and his morals and his history. And so, basically, Putin is fighting to defend his own country's integrity because he doesn't want to fall into the onslaught of Klaus Schwab and George Soros and those who want a one world government and basically confiscate all assets from everyone. I mean, that's basically what they're proposing. So I guess fortunately for us, in sort of a perverse way, and I say perverse way, we should be happy there's a China out there, even though they're bad players as well, and we're happy there's a Russia out there because they would protect us against this one world government nonsense, which is left untamed, would take us over in a whole other way. So who is our enemy? Is our enemy China, that they're going to take over? Well, yes, that's a possibility. Is our enemy Putin? I don't think Putin will take us over, but he could take over Europe. But then you got Klaus Schwab and the one world government people, and many, unfortunately, are sitting in the U.S. Congress and U.S. Senate, and one is in the White House, unfortunately. And they like to see, just basically a socialistic one world government, and which would the result would be that we own nothing, have nothing, and everything is taken from us. So you have to decide who your friend and who your enemy is in this scenario. And it's a tough call, but unfortunately, it's tough saying who's bad and who's good here. But I can tell you, there's definitely a war of philosophies at stake, and we're paying the price right now in the stock market for it, and we're paying the price for it in a lot of shortages and a lot of other things that are unfolding. So it'll be real interesting how this all plays out. Hopefully peaceably, but everybody should live and let live. Russia wants to do their thing, let China do their thing, and if Klaus Schwab and George Soros want a world government, they should set up their own little country somewhere and do it there to their own people and leave everybody out of it.
Maybe Elon Musk will lend them a spaceship to Mars.
If they're so unhappy, you're right. Leave the planet. Have them set up an encampment on Mars for them, and they can run a one world government out of on Mars or other planets. You're right.
Mark, thank you so much for being on This Week in Money.
Thanks for having me, Jim. Have a great weekend.
My guest has been Mark Leibovit, editor and publisher of the Leibovit VR newsletters, also known as vrtrader.com. Our conversation took place on Friday, April 29th. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, Rick Ackerman, and Mark Leibovit. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@howestreet.com. Now stand by for a company showcase update from American Manganese CTO Zarko Meseldzija. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at talkdigitalnetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen. Welcome to Company Showcase, an advertising feature on HoweStreet.com.
I'm Jim Goddard. I'm speaking with Zarko Meseldzija. He's the CTO of American Manganese. Welcome back to the show, Zarko.
Thanks for having me, Jim.
Zarko, the company put out a news release this week. What was in it?
That was for Evonik's Battery Solutions Day. They'll be hosted at MIT in Boston. Myself and our CFO Shaheen will be going down there. We are one of 15 finalists among over 120 companies that did apply. And we'll be, exploring different collaboration and investment opportunities with Evonik, which is a leading chemicals company, and they do have a lot of interest in the battery space. But moving on from that, the last podcast I did, I asked shareholders to send in their questions if there was something that wasn't clear, and I'll try and write everything down and address it in future podcasts. And that's exactly what I did. So just bear with me as I kind of go through the list of questions, and hopefully I've answered everything at least I can. And first being with the demonstration plant, as the expression goes, there's, the devil's in the details. There's a lot of, we have over 20 pieces of major equipment with fittings and connections and different customization needs that, really come, these unknowns that come up as we progress and experience kind of these ramp-up pains into operation. But it's not something that I'm concerned about or losing sleep over. I mean, I see the progression happening every day. Obviously, I think we got a little optimistic on the timing of things, but it's not an indication that something is wrong with the process. It's now just getting through each step of the way, and, we will get there. Next, there's a lot of questions on Statevolt, which was announced by Lars Karlstrom. For those of you who don't know him, he is the co-founder of British Volt, which is a gigafactory in the UK under development, and he's also the founder of Itovolt, who we have an MOU with to integrate our recycling process. Now, I really want to congratulate him on his announcement with Statevolt. He's a great entrepreneur, and he does see a bright future in the battery space. And, when it comes to Statevolt, I think we see a natural progression from our MOU with Itovolt, but nothing much more I can say on that. In terms of our MOU with Itovolt, Itovolt itself is still under development. Part of that MOU is to recycle scrap material from that production. So we are kind of waiting on those stages as we develop and as they develop, but we are in very close contact with Lars. Next, there were some questions on the infrastructure bill and different grants that are available. Now you're seeing a lot of money going into ESG, circular economy, and I just want to remind people, we do have Dan McGroarty, who's on our advisory board. He is based in Washington, D.C., and, he's our eyes and ears on the ground there. But when it comes to the infrastructure bill, the way this works, there's obviously the money that came from that bipartisan infrastructure bill needs to be allocated and needs to be decided what departments it goes into. So, there's a time gap between the announcement up top and the, strategy on establishing where those funds go, the writing of those guidelines, and how long, that does take time. But it looks like, we are, it is directly relevant to our development and what we're doing with recycling. We are comfortable and confident in the work pointing to the work AMY is doing, whether it's from a critical material standpoint or from an environmental standpoint. I feel like we do encompass that. And, we welcome that development as those guidelines are written and where that money will go. And I don't think we're behind. We will plan to be participating. But it's, waiting on those steps. And I think once, to reiterate, when something's announced up top, that does take some time before, things really start, getting into action. And then on top of that, while I'm talking about Dan on our advisory board, I also want to talk about, in particular, Johan that we have. He's a former, director of Central Europe for Tesla. He joined our board, our advisory board last year, as well as Jim Hahn. They really are great outreach, and they have brought a lot of eyes on our process from across the globe, covering Europe, Asia, North America. And even, they're responsible for many of the companies we are working with now. We also have Shalish, who is, leading the way at the the Gigafactory in New York State. And, he's a great one to lean on for, technical reviews and analysis and giving us feedback in the space. I just want to also mention that, we are working with different companies, and while we are waiting on, our demonstration plan to be built, we're not in a standstill phase. There's a lot of smaller samples of product, precursor product, lithium chemicals. They're still being produced and sent out for qualification. So that, that is all still happening in the background, just so everybody is aware. And that's really, for our advisors, I think we're a very well-known company in the lithium-ion battery supply chain. The next question I got was based on the institutional investors. I know since we did our raise of $20 million with institutional investors at $1, it's clear that the stock price is down from that point. People wonder how are the institutional investors feeling about this. We do meet monthly with the group to update on our progress. They understand the long-term vision. They obviously invested because they were satisfied with their due diligence. And they're very well, they do their due diligence, they understand the market conditions, and obviously, as we mentioned, the long-term vision of the company is very important to them as well. And then on top of that, with the $20 million that we did get, I think there's a misunderstanding in how that is being allocated. So bulk of the $20 million has been set aside and is really focused. Where we really want to focus that money is on commercial development. Right now with our office, we have a really lean office. We have low overhead. We're not sitting on a very large plant, just burning cash and really not much material, no supply of material going through. We are in a strong financial and technical position to weather the storms of the market right now. And just wanted to clear that misconception as well. And then the next point that we keep getting asked, when will the name change come? And I've mentioned this before. It's not as straightforward for a public company. I know Larry's mentioned it as well, but it is something that will be proposed during our AGM in the summertime. And it's most likely, some of you have guessed as well, we're keeping within that theme of Recyclico to focus on our recycling business and the work we've done with demonstration plants, and just so our name represents more of what's going on day to day. So those are kind of the main topics that I saw come in. I encourage you to send us emails, call us. If I can't answer your question right away, or if I see that question coming in a lot, I will just let you know. I'll answer it on a future podcast. And and we'll take it from there. Next week we'll be in Boston, and I'll update with any news that I can update and anything that comes up from the event. So thank you for your time.
Zarko, for people new to the company, what's it all about, and where can they get more information, and where are you traded?
Yeah, American Manganese is a critical metals company focused on lithium-ion battery recycling and upcycling, recovering up to 99% of the lithium, nickel, manganese, and cobalt in lithium-ion battery waste. You can get a hold of us. You can find a lot more information on our website, www.americanmanganeseinc.com. You'll find our emails, phone numbers. Feel free to call the office directly as well. And we are traded on the TSXV under the ticker symbol AMY, on the OTCQB under AMYZF, and on the Frankfurt Stock Exchange under 2AM.
Zarko, thank you so much for the update.
Thanks, Jim.
My guest has been Zarko Meseldzija. He's the CTO of American Manganese. I'm Jim Goddard. Our conversation took place on April 29th.
Comments made on Company Showcase are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at HowStreet.com. Company Showcase is a production of How Street Media Incorporated.